This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
When in income tax we dealt with the unincorporated trader, we saw how it was that we would go from a statement of profit and loss to be able to work out an adjusted trading profit. We would then compute and deduct our capital allowances to derive the tax-adjusted trading profit. And so it has been so in corporation tax as well, where again, with slight variations in the rules, for example, there are no private use issues when it comes to corporation tax, as there almost certainly will be in any exam question involving income tax. But the processes of adjustment of profits and capital allowances were the same. And therefore, we established a tax-adjusted trading profit, or a tax-adjusted trading loss. Now, when there were tax-adjusted trading profits, those would be allocated to the relevant tax year, income tax year of assessment, using for a normal ongoing business the current year basis, which I hope is all good revision for you now. When we deal with corporation tax, of course, life is a whole lot simpler, because we prepare a corporation tax computation not for a financial year, the year that runs from 1st of April to 31st of March, slightly different, of course, to the tax year that we use in personal tax, which runs from the 6th of April to 5th of April, as already mentioned. But we don't prepare corporate tax computations for financial years. We prepare them, as I hope you well understand by now, for chargeable accounting periods. And chargeable accounting periods will, on the vast majority of occasions, prove to be simply the period for which the company prepared its accounts. So for that period for which we prepare the accounts for the company, we adjust up the statement of profit or loss, we compute and deduct capital allowances, we get a tax-adjusted trading profit, and we put that into the corporate tax computation for the self-same period, whether that company has prepared its accounts to the 31st of March, 30th of June, 31st December, or any other date that it is free to choose. It doesn't matter. We prepare the corporate tax computation for that period. When we deal with losses, therefore, we will now establish, as we did with income tax, that if the business, the company, has made a tax-adjusted trading loss, then we don't put a negative to our tax computation. In income tax, we had a nil assessment going to the income tax computation. So it is now in corporation tax that a company making a loss for its chargeable accounting period will show a nil trading income assessment on its corporate tax computation. Now, of course, just because it has no trading profit doesn't mean to say that it will not pay corporation tax. The company may, as we've seen on a corporate tax computation, have other amounts chargeable. Interest income, property income, chargeable gains, for example. All of these are part of total profit, part, therefore, thereafter of TTP, taxable total profit, and will be subject to corporation tax. But we face a similar problem to that which we faced when dealing with income tax and the unincorporated trader making a loss. We know how to calculate it, fine, but what then do we do with it? What reliefs are available? We know we put a nil assessment, we do not put a negative figure into the relevant computation. For the unincorporated trader, the income tax comp, now for the incorporated trader, the corporation tax comp. But what are those loss reliefs? Well, having established a nil assessment in our chargeable accounting period, it is then very similar in terms of how we apply our loss reliefs to what we did in income tax. Now, of course, if you can't remember what we did in income tax, the next few words are not going to be much use to you. But I hope you do remember what we did in income tax. And it was essentially quite simple. We could relieve that loss in what in income tax was the current tax year, and or we could relieve it in the preceding tax year, or thereafter we could carry forward the loss. There's basically those three things that you can do with the loss. In income tax, use it in the current tax year, use it in the preceding tax year, use it in a future tax year. And the only question then was determining against what figure of income could we offset that loss in the current in the preceding or in any future tax year. Well, now when it comes to companies incurring losses and having a nil assessment on the chargeable accounting period for essentially trading income, it is by far the main loss, not the only loss, but by far the main loss that we have to deal with here, that we'll have that nil assessment on that corporate tax computation for that chargeable accounting period. But as I've mentioned, although the trading performance may have been poor and sustained a loss, there could still be other profits still chargeable to corporation tax. As we said, the interest income, the property income, the chargeable gains. Therefore, it is perfectly possible that that loss could be offset by the company in the current accounting period. Like an individual on an income tax computation could take their trading loss and set off against their total income, we will now discover that a company can take its trading loss in the current accounting period, chargeable accounting period, and set off against its other total profits, that interest income, property income, those chargeable gains. So a first possible use of a company's loss is within the current accounting period against total profits. We then see a slight difference to what happened in income tax. In income tax, if you wanted to use the loss in the current tax year or in the preceding tax year, you were free to do so. I hope you remember the claims set off against the total income of the current tax year and or the preceding tax year. Big difference now when we come to deal with corporation tax and we're looking at chargeable accounting periods. If you want to carry the loss back to an earlier chargeable accounting period, then you must firstly make a current period of claim. All of which, of course, notes will be within the notes I'll talk you through in a moment's time. But a big difference to begin with between the application of loss reliefs for income tax and corporation tax is in corporate tax. If you have a trading loss and you wish it to be carried back for relief in the previous period, essentially it will be a 1-year carry back. That should equate to a previous chargeable accounting period. But if you want to carry it back, then you must firstly use it in the current period. In both years, when you apply these losses, they'll go, as we'll see in the notes, against total profits. So in income tax, it was against total income. In corporation tax, the relief is offset against total profits. But it must be in a strict order. If you want to carry the loss back to an earlier accounting period, usually just the previous accounting period, then you must firstly make a claim in the current period. What we'll also see is consistent with what we did in income tax, you can't make partial claims with these reliefs. You can claim against your total profits in the current period, you can claim against your total profits then in the previous period, but you can't make partial claims. All of the loss will go against all of the total profits there. And that in turn may lead to not exactly the same problem, but a similar problem to that which we experienced in income tax. In income tax, the loss had to be set off in full against total income. And in income tax, total income is of course before the deduction of the personal allowance. And as partial claims were not allowed, it might result in a wastage, a loss of the personal allowance. Something, of course, you would wish not to do. If you fail to use a personal allowance in a tax year, then if you don't use it, you lose it, and that is something we would not wish to do if it could be avoided. Now, of course, companies, they don't have personal allowances, but you remind yourself of the corporation tax computation, and if you can't remember its structure, you should, and if you can't, go back and remind yourself there at the beginning of chapter 16 what that was. That what we did was we'd list out any trading income assessment, any interest receivable, any property income assessment there, any chargeable gains. And that listing of income and gains would then come to a subtotal known as total profit. But that was not in all cases the TTP. the taxable total profit. Why? Because away from total profit, there would be a deduction for any qualifying charitable donations paid during the accounting period. And now you see the problem in terms of how this current period and carry back relief affect you, the company, in terms of corporate tax. The relief is in full, no partial claims, against total profits. Total profits are before the deduction of the qualifying charitable donations. Therefore, if the loss is bigger than the total profit, that will eliminate all of that total profit and mean there is nothing then for the donation to be set against, therefore wasting that as a deduction. You will have used a loss, the benefit of which, if not used in this period, may have been usable in another period, if not now then in the future. And what has happened is you've used a loss to remove some profit that would have been covered by that donation. That has wasted that donation and therefore is inefficient use of the loss. Okay, let's have a little look therefore at the notes that hopefully bring all of those points together. Now, as I've said, by far the most important and therefore obviously most examinable loss is that of trading losses. We'll spend just a couple of minutes in a short while looking at the non-trading losses. They're quick and easy to deal with, but they're never going to be a major component so far as our exam is concerned. As we've already said, if a company makes a trading loss, then its trading income assessment for that period, that will be a chargeable accounting period, to include within that corporate tax computation, prepared, I say again, for the chargeable accounting period, is nil. We never put a bracketed, a negative figure into the computation. The assessment is nil. We then decide of the loss reliefs available to us, which one or ones shall we choose. How may that loss then be relieved? Well, in the current period against total profits, followed by a 12-month carry back to an earlier period or periods, again against total profits. Now again we note there a 12-month carry back. It is most likely that the company will have and now continues to prepare its accounts to a set regular date within the year. So every chargeable accounting period is for a year end, in which case when you carry back it will indeed be against the total profits of the preceding chargeable accounting period. But as we've seen in the previous chapter, chapter 17, a company may change its accounting date. And however it does it, whether it does it, as in chapter 17, by the use of a long period of account, or indeed by the use of a short period of account, it is possible to see a chargeable accounting period of less than 12 months. Never more than. That was one of the first basic rules we ever learned. Never more than, but it could be less than 12 months. That was the rule that we saw. So in which case, if we had now a loss-making period that was preceded by, say, a 9-month chargeable accounting period, then the carryback of 12 months would cover all of that previous 9-month chargeable accounting period, and as we'll see in a later example, it would go on to cover a further 3 months of the accounting period prior to it. So it is, very precise, a 12-month carry back, usually to the preceding chargeable accounting period, it being of 12 months. But if it was of less than 12 months, then all of that period would be relieved, followed then by the balance of the 12-month period for which you could carry the loss back. If you want to carry back, as we have said, then you must make a current period claim first. But you might not want to make a current period claim. Or if you have made a current period claim, you might not want to make a carry back claim. These are options available to you. You don't have to make both a current and then a carry back claim. But any losses that have not been used, either in the current period claim that must come first, or then within the carry back claim that can only follow the current period claim, any losses that then are carried forward, what happens to those? Well, now, in addition to what we've said about current and carry back claims, and or by carry forward, to relieve against, now's an interesting term, any part of future total profits. So whereas on a carry back claim, it was all or nothing, there was no partial claims, all of the loss against all of the total profit. Now, under what in fact are new rules brought in for use from the Finance Act 2018 onwards, for our particular legislation, what we now have the ability to do on a carry forward is to make a partial claim. What it actually requires us to do is to make a claim to HMRC saying that we want to restrict the use of the loss to a certain figure. So we are able to make partial claims, again against future total profits. Now, of course, given what we said 2 or 3 minutes ago, why is it that you would wish to make a partial claim? You know that if you apply all of the loss against all of the total profits, and those total profits are then eliminated, it would mean that if there were qualifying charitable donations paid during the accounting period, they're going to be wasted. They're gone. And that, of course, is a price you pay, or may have to pay, for making a current period claim and then a carry back claim. But it is no longer a problem in terms of a carry forward claim. Any carry forward may go against any part of the future total profits. You can restrict the claim to leave just sufficient of your total profit, still chargeable, is sufficient to cover the deduction of the qualifying charitable donation. So again, a useful issue there, a recent change, therefore one that is likely to be tested in the next round of examinations in terms of the Finance Act 18 exams there. First time they've ever had this particular rule to play with, and no doubt it will be used in terms of our exams. The use of the loss carried forward in this way is only available for losses arising from the 1st of April 17. Now, I would imagine that most of you now studying for your examinations under the Finance Act 18 are probably seeing it for the first time. Or if it's later on in this cycle, you've only experienced Finance Act 18. But if there are any of you out there who have studied under Finance Act 2017 rules, or indeed prior to that, this is a very big difference to what happened before. So now, these rules about what you carry forward the losses to set off against and how you offset them, i.e. partial claims being allowed, this is new, and it's only effective for losses arising from the 1st of April 17. But, thankfully indeed, brought forward losses that arose prior to the 1st of April 17 are excluded from the syllabus. So we only have to deal with, and if presented with a loss brought forward in a current accounting period for us in our round of examinations, that loss would have arisen post 1st of April 17 and will be used in the way prescribed. Any such trading loss brought forward may then go against any part of the future total profits here. Note, if a company wishes to carry back a loss, as we have said and emphasised so many times already, it must firstly use the loss in the current period. And unlike with the carry forward claim, partial claims are not allowed in either the current period or the carry back claim. So the carry forward provisions are far more user friendly than the current and carry back claims. In terms of these reliefs, as the corporate tax rate has fallen to 19% from financial year 17, the choice of which loss relief to claim will be based on various criteria. Factors such as achieving relief at the highest tax rate. Now, if you remember, in income tax, this was a really, really important issue. You might be able, in an income tax situation for an unincorporated trader, set off a loss against income that would have been charged at a 40% higher rate of tax. Yet in another tax year, it may only have gone against income chargeable at the basic rate of 20%. Very clearly, therefore, we would prefer, if we could, to achieve relief at the highest tax rate. Now, companies these days, and now for many years, have only been paying tax at a single rate. There's no progressive rate of taxation, as we have with income tax 20 to 40 to 45 as the income levels passes from one band to another. What we have in corporate tax is a single unified rate. But that rate had been coming down over the years. It had come down to 20% in FY16 and then to 19% from FY17. So if you were able, depending on what is the accounting period of loss and what relief you are claiming, but if you were able to carry back to a period prior to FY17, then that would guarantee that the loss is being used at a higher tax rate. Now again, if you went back to FY16, it would simply be 20%. It's not a big difference, is it? Going from 19% to 20%. It's not like in income tax, where it could be the difference between saving tax at 20% or 40%. Saving tax at 20 or 19 is not going to set the world alight. Now, although the percentages are very small in terms of their differentials compared to income tax, it's still a point of principle and still one that you should be aware of. Plus, of course, relief at the earliest available opportunity would also imply that it would be better to carry a loss back rather than carry it forward, because that would generate a repayment of previous year's tax paid. That would be money coming back to you now, rather than, say, a carry forward claim that would simply reduce a future year's liability. So again, relief at the earliest available opportunity. Therefore, depending on the dates of the accounting period of loss, potentially favouring a current period and then a carry-back claim rather than a carry-forward claim. Now, of course, although those particular points, relief at the highest rate, relief at the earliest available opportunity, would favour using the loss sooner rather than later, what we have, of course, seen is that if you make a current period, thereafter you make a carry-back claim, they cannot be partial, and hence they run the risk of wasting relief for qualifying charitable donations, as total profits, as you know, are before the deduction of donations. And if those donations are therefore unused, then they will be wasted. Clearly, that is inefficient use of our loss, using a loss to take out profit that would have been covered by those donations anyway, and those donations now lapse, they are lost. However, if a loss is carried forward, then under these new rules, effective from 1st of April 17, a partial claim would be available, therefore allowing you to avoid wasting any such qualifying charitable donations, as we spoke of but a moment ago. Now, while still discussing the issue of, so what are the objectives, what are we trying to achieve? Yes, there's a range of options. We've got the basic gist of that now, current period, carry back or carry forward claims. What are these objectives? Well, we've seen, like we did in income tax, relief at the highest rate, relief at the earliest available opportunity, i.e. a cash flow advantage using the loss sooner rather than later. So it is also the case when dealing with companies. Again, we would, if all the rates were the same, still like to use a loss sooner rather than later in order to get either immediate repayment of tax paid for an earlier accounting period, or reduce this year's tax to be paid, either of which are better than reducing a future year's tax from it being payable at that future point in time. But there's a further, most important cash flow issue. To seek the best use of losses, to avoid the requirement to pay the corporation tax liability when you pay your tax, this is all about cash flow, by quarterly instalments. Now, the full detail of that is contained in Chapter 23, which I know we haven't yet done. We made reference to quarterly instalment payments at the beginning, early on in Chapter 16, when first introducing the concept of corporate tax and the corporate tax computation. Suffice it to say, before you move to Chapter 23, that if you have to make quarterly instalment payments, then those payments are being made some considerably ahead of when you would otherwise have had to have paid your corporation tax. Again, I hope that we recall that ordinarily a company will have to pay its corporation tax 9 months and 1 day after the end of the chargeable accounting period. 9 months and 1 day after the end of the chargeable accounting period. As you'll discover the detail of quarterly instalment payments in Chapter 23, those are likely to start to become payable just over halfway through the current period to which they relate. So you're going to have to start paying the tax for the current period within the current period and then shortly after the end of that period, rather than only having to pay any and all of that tax 9 months and 1 day after the end of the period. Clearly, a company would not wish to have to make quarterly instalment payments if it could avoid it. Now, what do losses do to profits? Losses reduce profits. What is the relevance of that? Well, the relevance of that, as per your introduction in Chapter 16, was that to make quarterly instalment payments, because it wasn't routinely required of companies to make such payments, and of course they're not going to voluntarily choose to do so, they're only required when a company is a large company. When a company is a large company. And that's a measurement in terms of its profits. Now, what do losses do to profits? They reduce profits. And if by the use of a loss, you could reduce a profit below the so-called profit limit, and again, if you do not remember, if you do not know what I'm now talking about, you go back to the early pages within your introduction to Chapter 16 there, and you see the references to, again, large companies being required to make quarterly, or may be required to make quarterly instalment payments. The mechanics of that system, as I say, that awaits us, it awaits you in Chapter 23 there, the admin part of corporate tax. But clearly it's something that you would wish to avoid. Therefore, where you apply your losses, they will reduce profits. If you're able to reduce profits down below the profit limit, thus therefore you are not any longer large, you are not large, then that means that you have avoided the requirement to make quarterly instalment payments. This may be particularly important within a group of companies. At the moment, and throughout this chapter, we'll be looking at just a single company. And what can it do if it makes a loss? We'll discover in a later chapter that if you are within a group of companies, then there is the ability to group relieve a company's loss, which it's a nice title, group relief, but don't be put off by that. It's a simple idea that one company making a loss within a group, instead of only being able to use its own loss against its own total profits, what it may instead choose to do is to surrender some part of that loss. Yes, we can make partial claims with group relief, we could surrender some part of that loss to a fellow group company. Now again, we haven't defined which group companies. That is in Chapter 22, dealing with groups and group relief. But the concept is a simple one. We can move any part of a loss out of the loss-making company and allow it to be used against the profits made by a different group member. Now, if therefore we were able to use losses made by one company to reduce profits in one or more other group companies down below the profit limit, that would enable us to avoid making quarterly instalment payments, potentially not just in one company, but maybe two or more companies. That would be a very big win so far as our group of companies are concerned. What does it do? As we've said, it allows any part of a trading loss, or indeed, don't worry about it at the moment, a business property loss made by one relevant group company. Of course, we will need to, and we will define that in Chapter 22, to set off against any part of the TTP of any other relevant group company. Group relief also now allows brought forward trading and property business losses to potentially be included in a group relief claim. Don't even go there. Don't worry about that now. That awaits us in Chapter 22 there. So let's just sum up. In terms of what are your objectives to get the best use out of your losses? They're simple. Like with income tax, you would like to gain relief at the earliest available opportunity. So carrying a loss back would be preferable to carrying it forward. But of course, you want to relieve at the highest tax rate, and you want to avoid wasting any of that loss. You want to avoid wasting a personal allowance in income tax. You want to avoid wasting qualifying charitable donations when it comes to corporation tax. And another hugely important cash flow issue, as we've just been discussing, is that if either you're a single company or within a group of companies, any such company is a large company, could the use of a loss made reduce that company's profit down below the profit limit to remove it from the categorization of large, and therefore remove any such requirement to make quarterly instalment payments? That would be a huge cash flow advantage, allowing the company to continue as it would always have done hitherto, which is to pay its tax 9 months and 1 day after the end of the accounting period, instead of having to start making such payments just over halfway through its current accounting period. That would be a big win if we could avoid having to make those payments. All right, we won't talk about non-trading losses at the moment. Let's just put into practice and see the individual detail of how these trading losses are used. If you are told in a question that a company wishes to claim relief at the earliest available opportunity, a fairly standard requirement, certainly in past examination questions, what would that mean? It would mean that the first relief that you would claim would be this one, current period. Now you know that there are 3 ways you could use the loss: current period, carry back, carry forward. So the earliest available would seem to be the carry back. That's the best in timing, it's the best in cash flow. You get a repayment of last year's tax instead of merely a reduction in this year's tax. But remember, when in corporation tax, if you want to carry a loss back, what must you do first? You must make a current period claim. So that would be the first one. What do? The loss may be relieved against total profits, which, as we know, is before the deduction of qualifying charitable donations in the period that the loss arose. The loss must be applied in full. No partial claims are permitted. We also know that where there is a loss, the assessment is nil. So here, A Limited had the following results for the year ended 31st of March 19. Show how current year relief would be obtained in the year ended March 19. So the trading loss of 45,000, that would be a nil assessment. We then have interest receivable, 20,000. Chargeable gain, 50,000. And at that point, we would get a subtotal, total profits. Now, if you do not know your way around this computation, you need to go back. You're not going to understand how to apply and use losses and the various loss reliefs if you don't understand the basic structure of the corporation tax computation. So we've got total profits of 70,000. What is the claim against in the current period? It is against, of course, total profits. Total profits being before the deduction of these qualifying charitable donations. So we take our less, what would be current period relief. Again, you'd write that out in full, of course, if doing a written question. If you're doing an objective testing question, you're just scribbling it down, much as I am here. What is that loss? There you go, it's 45,000. Now on this occasion, there is more than enough profit to absorb that loss, and that will still therefore leave, well, what will that be, 45 from 70? It'll still leave £25,000 of remaining total profit. Sufficient, therefore, for you to then deduct the qualifying charitable donations, there they are, £15,000, and bring you down to a revised TTP of 10,000 that will be subject to corporation tax at, well, this is the year ended March 19. Hopefully you'll understand that that falls entirely within FY 18, and on that basis it would be taxed at 19%. Right, now remember these claims in the current period, and then as we've seen carry back relief, a 12-month carry back, they are in full, can't be partial, and go against total profits. So if, for example, here, the total profits that we were dealing with had been, say, £50,000, you would take out your current period claim, that's your £45,000 loss. That would leave you with only 5,000. You would have paid a donation of 15,000, but that will simply bring you down to nil as your TTP. You would only have used 5,000 of these qualifying charitable donations. The remaining 10,000 would have been wasted. If you can't use those donations this period, you can't therefore carry them forward for use in a future accounting period, and they most certainly can't be carried back. You need to use them now. If, of course, the loss was bigger than the total profits, here our total profits were in fact £70,000. If the loss that we had there was £145,000 instead of £45,000, then all of that loss would go. Now, of course, there'd be a price to pay, because now there'd be nothing against which to offset those donations. So we still have a nil TTP, but you'll have wasted the £15,000 worth of donations. But what it would mean is, if you had a £145,000 loss, and you've now used their £70,000, you've got a balance of £75,000 to carry back. Now and only now could you carry back. So what's the carry back relief? Having first relieved the trading loss in the accounting period of loss, that must be the first thing you do if you wish to carry the loss back. If you wanted, of course, to carry the entire loss forward, that is entirely your choice, and you are free to make that choice. But if you want to carry the loss back, then the requirement to access that carry back is that you must firstly make a current period claim. So having first relieved the trading loss in the accounting period of loss, the current period, only then may any remaining trading losses be carried back again against total profits, whether it's current period, whether it's carry back, and since the 1st of April 17, when now you carry forward, the loss is offset against total profits, which as ever is before the deduction of the qualifying charitable donations. And we now go back against the total profits of the preceding 12 months. It is exactly a 12-month carryback. No shorter, no greater period. Exactly 12 months. And again, no partial claims. The loss must be applied fully against the available profits. As we know, partial claims, for example, to leave sufficient profit to cover the qualifying charitable donation are not allowed. Not in a current, not in a carryback claim. They are, of course, allowed on a carry forward claim. These claims, therefore, may result in no tax relief being achieved for any what would be wasted qualifying charitable donations. Right, what have we got here, therefore, in example 2? And we'll just deal with this one to close this particular session. Right, A Limited has the following results over recent years. We've got 3 accounting periods there. All years end the 31st of March, 2017, 18 and 19, and 19 is the period of loss. Show how loss relief would be claimed, assuming that the relief is taken as soon as possible. Now, as soon as you see those words, relief at the earliest available opportunity, relief taken as soon as possible, what does that mean the running order of your claims would be? What is it going to be? That equals, firstly, current period, then carry back, and only after that, if anything is left over, will it be carry forward. That's the running order. Now again, you know how to set up your workings for this. As you see it here in columnar form, you copy these numbers into those same columns, except that one, the £90,000 loss, of course becomes a nil assessment. And we'll then keep a separate loss memorandum going to show how and where we've used that loss. Where will you firstly use it? I'll talk you through, but I'll expect you to be able to do this and show this before checking the answer, of course, in the back. It'll go against that 10,000 to begin with. It goes against total profits. In this current period, you'd have a nil assessment, £10,000 of interest receivable, total profits 10,000, current period claim 10,000, eliminating all of that total profit. Once you've done that, then in your loss memorandum working, you'd have shown the loss, that was 90,000, less current period claim, 10,000 equals 80,000. What can you do with that? You can carry it back. How far back? 12 months. Exactly 12 months. Well, here exactly 12 months, as it would be in the vast majority of practical circumstances, is simply the previous chargeable accounting period. Here, the year ended March 18. What did we have? As written there, trading income 60, interest income 10, total profits 70,000. How much loss do we still have available? We started with 90,000, we've used up 10,000, we still have 80, more than sufficient to cover all of that 70,000 and bring again our profits down to nil. On your loss memorandum, you'd show the use of the 10, the use of the 70, out of the original 90, thus leaving £10,000 to carry forward. What do you carry it forward against? Against the future total profits. But future total profits where partial claims would be available to you. Okay, we've had a lot to fill our heads during that particular session. Hopefully, therefore, if you need to go back, please do so. You're okay with that. Check through again the answers to each of those examples. Make sure you've understood these rules before joining us for the next session, dealing with our corporate tax losses.